Good evening and welcome to this session of the live learning classes conducted by the Board of Studies. It's great to be here again, continuing on the topic share capital and debentures. As usual, let me begin with a small invocation. Sahana bhavatu, sahano bhunaktu, sahaviryam karvavahai, tejasvina vaditamastu, ma vidvishavahai, om shanti. Shanti, Shanti. Great. So, before we go into the topic, I find some queries are there, I think. So, let us just see that. And so, we have Parth Rana, okay, acknowledge. Thank you for Mr. Parth, Ms. Gunjan Devi, Ms. Prayarna Jadhav, and Mr. Srinivasan has got a question. Let's see that. Example 5, the below illustration MCQ in page number 4.19. Of the study material. I was also taking that only. I think yesterday also you have pointed it out. I was planning to discuss that now. See, Mr. Venkatraman has pointed out that, Mr. Srinivasan has pointed out that there is a mild confusion in one of the illustrations given in the material regarding variation of shareholders' rights. I'll definitely consider that before we proceed. So, well, again, Madhav Tiwari is here, Ajay Chauhan, Mohammad Sohail. I'm great, sir, doing great. Before you ask me, I'm telling you, I'm doing great. Divya Kumari, Shantika, Kadambari, but wow, Hardik. So many of you, Neha, Harge, nice of you to all put your, I'm not able to read all your names. But as and when you ask questions, I will definitely mention. Madhav Tiwari wants to know what is the meaning of dissenting. So let's quickly go there. Let's quickly go to variation of shareholders' rights and then move on where we stopped. I think variation of shareholders' rights. This is where the word comes now. Dissenting shareholder. See, what is the meaning of assent? Let us begin with that. When I agree with something, I am assenting, A-S-S-E-N-T-I-N-G, assenting, agreeing. So what is dissenting now? Assenting means agreeing. Have you given your assent? Yes. Consent, assent. So the opposite of assent is dissent. That means I am not agreeing. So did you notice here? Holders of not less than 10% of the issued shares who did not consent, they are called dissenting. Who have not assented, who have not consented, who did not consent. Okay, they are called dissenting. So when I am not agreeing with it, I should be allowed to go. See, boss, it's like this. I am going for a tour with the 10 people. We have all planned to go to Taj Mahal and have a look at it in Agra. Suddenly, these fellows are saying, no. We will not go to Taj Mahal. Instead, we will go straight to Haridwar. Hey, I didn't come to go to Haridwar. Yeah, I came to see Taj Mahal. So what happens? I say, come on, let me go. I don't want to join you. So I'm a dissenting man. And what they will do, okay, up to now what you have paid here is balance amount, expenses are adjusted, balance refund you take, go. So at least you let me go. That is what it's done here. So these fellows will go to the tribunal and say, kindly do something, or they will be asking that they let this be not take effect. But if tribunal says no, then the variation cannot be done. If the tribunal says yes, then the variation will be done. Okay. Page 4.4. 1 second, I will explain. 4.4. What is that? Kindly explain the presentation of shares and debentures in balance sheet. Page 4.4, first paragraph. Yeah, madam, I'll read that part. Both the shares and debentures are presented in the balance sheet on the liability side of the issuer company, on the asset side of the investor and lender respectively. This is basic accounting, madam. See, you are the investor. You are the investor. For you, for the investor or the lender, it is an asset now. I don't know why this paragraph is included here. Only to confuse you. This is nothing to do here. This is to do with accounting. Madam, you are investing in a company. You are the investor. In your balance sheet, where will you show that share? It will be shown in asset side. You are the lender. You have lent money to the company. In your balance sheet, where will you show? On the asset side. The company is receiving. So it is the borrower. So where they will show? They will show it in the liability side. Am I correct or not? They will credit the giver. Now, you, of course, in this case, see, unnecessarily I'm teaching accountancy. See, in this case, share capital and debentures, they will not credit Tunishka account. They will combine all the debenture holders, all the shareholders, and call it share capital. So they will credit account called paid up share capital account, like that, debenture account, like that. That account will be shown on the liability side of the balance sheet. That is all. If you have still not understood it, don't bother. When you are learning accountancy, somebody will teach it to you. Corporate accounting, they will teach it to you. This is fairly simple, straightforward, basic bottom line point. I don't know why they are mentioning it here and why you are unable to understand it. Okay, it is basic accounting now. Share capital, where will you show? Yeah, on the balance sheet, liability side now. For the company. For the investor, where he will show, for him it is an asset now. See, later they get it money back. So when you invest shares in Reliance Industries Limited, where will you show it in the balance sheet? On the asset side. Same logic. Okay. See, the bank is lending now. The loans given by the bank, where they will show? On the asset side. Of the bank's balance sheet, it will be asset side. Okay. So, yeah, coming back to variation of shareholders' rights, if there are 10% or more percentage of holders, or why are you using complicated language like this? Yeah, in the slide, I have given you clearly one wording. Why don't you use that? If not less than 10%. See, you are complicating part. If there are 10% or more percentage of holders, why? Not less than 10% of the holders of not less than 10% or not less than 10% of the holders of issued shares are dissenting, then they may apply to the tribunal. Exactly. That is what is given in this slide. The slide that you are now looking at exactly says that. So you can, I hope you understood. Why I am saying this now, unnecessarily you are making long-winded entries. Use simple English. My wife, whenever at home, my wife always says kiss. No, don't think something else. What she is saying is, keep it short and simple. Keep it short and simple. Okay, this is a golden rule of writing, especially in English. The more complicated you make a sentence, the chances of error. So make it simple. Keep it short and simple. Nothing contained. You saw nothing contained in this actual effect. 1 second. 4.7. Madam, who's that? Tunishka. Hello. Don't do this. Tunishka, don't play this game because I have not come to preference shares. When I come to preference shares, I'll teach you. Don't drive me. Let me be the judge on when I will teach something. Okay? Please. Don't do this. See, this topic is preference shares now. When I come to preference shares, I will tell you. Don't worry about that. Preference shares, I'm going to deal with them separately. At that time, I will tell you. Okay? Not now. Okay? So, again and again, I'm saying, I am not teaching the Board of Studies material. Please do not make me do that. I am only referring, when you're having a doubt, I'm doing. But don't do this because Board of Studies material was not prepared by me. Okay? And I'm not following it. I have got my own PowerPoint, which is as per that only. Broadly, there will be some differences. So, I can't keep on going there and explaining word by word to you. We just don't have the time for that. But I will explain. Basically, this pertains to participatory preferences. When I come to participatory preferences, I'll explain it to you. Don't worry. I will explain it to you. Okay. Good. Welcome, Mr. Jha. Now, coming to the point, I think Mr. Jha is also slightly senior person. Chalo. Now, this doubt asked by Mr. Srinivasan, we have to take it up. That is pretty interesting because there does seem to be some kind of anomaly in that particular illustration. See, on page number 4.19 of your Board of Studies material, there is an illustration. A resolution sanctioning the variation has been moved on 1st November 2022. So, the variation has been sanctioned on 1st November 2022. When should the application be filed? Within 21 days. Within 21 days. So on before 22nd November. Why? Because if it is made on 1st November 2022, we should not count 1st November. We should not count 1st November. So counting from 2nd, you have to count 21 days. Counting from 2nd. So 2nd, 3rd, 4th, 5th, 6th, 7th, 8th, 9th, 10th, 11th, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. So 22 is the 21st day. So it should be filed within 21 days. So it should be filed by, that is within 22 November. If you count 21, you will understand. For counting 21, you should not include that date on which the resolution was passed. This is the general rule. Whenever you will find it in, if you have General Classes Act in your syllabus, you will read it. Otherwise, you will not. If it is not in the syllabus, no problem. If they have removed it now, please don't educate me. You don't get educated. That is the only problem. If it is not in syllabus, good. If it is in syllabus, good. Okay. If it is there, you know. But otherwise also, whether you are reading it or not in the syllabus, General Classes Act is there. Under the General Classes Act, they say when days are to be counted, when the word from is used, when the word from one date to another date is used, that date from which you are counting should not be taken. You should take only the next day. So you have to file it within 21 days. Within 21 days, okay, from the date on which the resolution is passed. So when that from is used, then the date on which the resolution is passed should not be counted. So from the next day, that is 2nd November, you have to count. So if I counted it for you, it comes to 22. So 22 is the last day. Before 22 working hours, you have to file. If it is 24/7 online filing, midnight 22 is the limit before which you have to file. Now, the tribunal has passed an order on 4th January 2023. Correct. Now, within how many days you have to file? The company shall, within 30 days of the date of the order of the tribunal, file a copy of the same with the registrar. So within 30 days. So again, you have to count to 30 days now. Again, you have to count 30 days. For that, what you should do? 4th January order has been passed. So 4th January cannot be taken. So you have to take from 5th. In other words, 31 minus 4. 31 minus 4 days in January, chhod dijiye. Which means what you have? 27 days in January. Right? You need to count 30 days. Already 27 covered. So 31st, on 31st January, 27 days over. So 1st February, 2nd February, 3rd February. So 3rd February, you should, by on or before 3rd February, you should file the copy with the registrar. But unfortunately, the board of the printing says 6th March 2023. Because even assuming it is 60 days now, even assuming it is confused as 60 days, it cannot be 6th March. It has to be 5th March. Because if it is 6th March, it will become 61 days. So, even assuming that somebody has confused a 30 for 60, still, I think. Whereas, see, here itself, it is very clearly said, the company to file a copy of the order with the registrar within 30 days. So, if you count 30 days, I am not getting 6th March. I am not getting 6th March. I am getting only 3rd March. I'm sorry, 3rd February. So, kindly note it. And, yeah. Okay. So, Madam, I will explain to you. See, nothing contained in this act means what? See, earlier when I come to preferentials, I will teach you. Don't worry, Tunishka. Just hold on. I will easily teach you. Don't worry. Yeah, thank you, Ms. Neha. Yeah, see, there is a special method of learning theory papers. You cannot approach the theory paper like a computational paper. So, simplicity is better than complex. Use simple English. Slowly, you will pick up the outright. I am not aware of negative marking. Kindly ask the institute. Don't ask me. Go to the institute website or approach the Board of Studies and they will clarify it for you. Board of Studies ka people hai na, They are always there. There is one mail ID is there. You send a question, they will reply to you. Because I'm not aware of that. Seriously, I'm not aware. I'm not interested also. I'm here to teach the subject. Okay, don't worry. I am not that type of coaching faculty who is interested. I will teach you the subject. Don't worry. I'm not aware of all that. I'm not able to. Otherwise, give me time. I will confirm and tell you. Okay, please. I'm not able to answer it straight away. And one more thing, you are violating one rule I said, Gadar. Don't interrupt my class during the session. Please do not ask non-subject related questions. I think I have made this request many, many times. After the session is over, please put the question. If I have time, I will answer or I will take it up and I will do it. Please, during when a subject is being taught by me with interest, do not interrupt with a unconnected question. Have some kindness on the faculty. Don't do this. Okay. So 4.19 illustration I have explained. The other one I will not explain. You read it on your own. It is very clear. There is one example 5 I have done. Illustration, I cannot explain it. Please read it. It is there clearly. It is there. They have given the answer also. Very clearly, they have given the answer. Read the answer. If you have a doubt, you ask me. I cannot. Anyway, since you are asking, I will answer now. DBS Chemicals Limited, and the English is so bad. I am not able to understand it also. It's such a bad English. I don't want to read it. DBS Chemicals Limited issue ordinary share of, in what English? Issue share of different classes. DBS plan to vary rights of one the class wherein there were only 105 holders. 100 out of 105 holders own 0.5% shares of that class. 100 out of 105. So total there are 105 holders. Of that, 100 of them each hold 0.5. So together they are holding 50%. 100 of them hold 0.5% each. So 100 into 0.5, you get 50. So together these 100 fellows are holding 50%. Another 5 holders are holding 10% each. Whereas each of remaining 5 holders hold 10% shares of that class. So 10 into 5, 50. So 50, 50, 100. Okay, 105 holders, 100 are together holding 50%. 5 are together holding 10, 10, 10, 5, 50%. Presuming 100 holders, yeah, see how bad in what I'm unable to read. See, I'm getting irritated when I read this type of bad English. Yeah. 100 holders who own 0.5% of the shares already signed, authorized the consent letter. How many holders out of such 5 need to authorize? Meaning what? What is the condition? What did they say? What are they saying here? This can be done with the consent in writing of not less than 3/4 of the members of that class. Am I correct? So holders of at least 75% of the issued shares of that class must have given their consent in writing. Okay. Mind, it is 75% of it issued shares holders, not 75% of holders. They are trying to make the point that this can be done with the consent in writing of 3/4 of the members of that class. What happened? What does the section say? Once again. I'm so sorry. Maybe I made a mistake here. That's a good thing I took this up. Give me 1 minute. Give me 1 minute to get it clarified with the act. If so, I will correct it now itself and I'll teach you again. Unless they've amended it again. Once again, just give me 1 minute. I'm just going through the section. I would actually prefer to go to section actually now. Yeah. Sorry, ma'am. I'm very, very sorry. The section says, I'm very, very sorry. The section says, holders of not less than 3/4 of the issued shares of that class. So sorry. It is my mistake. I will correct it here. Okay. Here it says, this can be done with the consent in writing of the holders of not less than 3/4. I don't know how I got this wrong. When I got it wrong, I don't know. Of the issued shares of that class. Okay. So sorry. Which is one of the reasons why I don't share my material to you beforehand. I don't know where I got this 3/4 of the members from. So what does it now read? This can be done with the consent in writing of the holders of not less than 3/4 of the issued shares of that class. So taking this example, what are we talking about? Totally 105 holders are there. 100 of them are holding 50%. Another 5 are holding 10 each. So totally 50. That means, okay, 3/4 is 75%. We'll take it that way. If 3/4 of the holders, see there is that the holders of at least 75% of the issued shares. Holders of 3/4. So shareholders of 3/4 means what? Members holding 75% of the issued shares. So here, these 100 people together are holding only 50%. Only 50%. We need another 25%, which means minimum another 3 people should agree. Because only if another 3 people agree, what will happen? It will become 50 plus 30, 80. So it will be not less than 3/4. Okay. So I'm so sorry about this mistake. My humble apologies to all of you. Anyway, thank you for asking me to explain this thing. Once again, 100 people are holding 0.5%. So each of the 100 is holding 0.5. Together, how much? 100 into 0.5%. So 50% of the shares are held by 100 people. Another 5 people are holding 10% each. So 5 into 10, 50. Now, for this section, consent is needed from the holders of not less than 3/4. That is 75% of the issued shares. Right. So 75% of the issued shares means how much? 75%. 70% of 100. The 100 fellows are holding only 50. The remaining 5 are holding another 50. Each is holding 10. So minimum I need 3 more guys, 10, 10, 10, 30 to vote so that I will get 75. So the answer is 3. Okay. So in a way, I found I possibly with the guidance of Mr. Srinivasan found there is one discrepancy. There is a discrepancy in my notes also. So all's well that ends well on this. Hope you are now clear. Any doubt is there, you ask me. I will explain because this, no problem. Ramjav, if you please don't put, I can't understand, sir. Not a good idea, sir. You have to tell which you don't understand. If screen is not clear, just check its screen is coming correctly only. Kindly, 1 or 2 of you confirm that I have explained 4.19 illustration now, that MCQ, that confirm that you have understood it. I will explain if you want one more time. I have changed my notes based on this. In your institute material, it says 75%. I'm using 3/4 because that is what is said in the section. They are only talking about 3/4. Okay. So I'm using 3/4 here. This is section 48. Okay, of the Act. So sorry, I don't know how I got it wrong. I'm so sorry. Not less than 3/4 of the issued shares means holders of not less than. Not 3/4 of the members. That's what they are saying. Mind it. 70% of issued shares, not holders. Not of holders. So, which is what I have written, 3/4 of the members. So, it should be actually 3/4 holders of 3/4 of the issued shares. So, totally 100 shares, 100% is there, let us say. 100 fellows are holding 50%. 5 fellows are holding 50%. So, if these 100 agree, we still got only 50%. Whereas I need 75. So, minimum another 3 should agree. 3 means how much I'll get? 10, 10, 10, 30%. Once I get that 30, total consent will be 50, 100 fellows holding 50, plus these 3 guys holding 30, 80. 80 will be not less than 3/4 of the issued shares of that class. So, okay, I have explained it to you. Now, hope you have understood. Kindly, just for the sake of my own happiness, just confirm that it is clear. Thank you. And okay, I'm very sorry about this. In a way, God is great that who asked me to explain, I will thank them personally. Very good, very good, very good. Very good, very good, very good, very good, very good, very good. Everybody has understood. 1 second. Yeah, Ramja only I have to thank. But I hope Mr. Ramja has understood it. Okay, he only asked me. For him, I thank. So, Mr. Srinivasan, I have answered that also. Thank you. Good. Now, Lokesh, what you are explaining from PPT presentation prepared by your own. If we write the answers of what you are explaining, will we get marks? And board will allot marks. How do I know, sir? How do I know? If you ask me questions like this, how can I answer, Lokesh? If the answer is correct, they will definitely give you marks. Of course, if you use this language, whether you will get it if you are asking, yeah. This is the language I used for writing my exams. I got nothing less than 70%. So, I don't know. If you still want to use, it's your choice. Otherwise, you can always mug up the institute material and reproduce. No problem. Both are same. And you won't find much difference between. Somewhere what I would have done, I would have made diagrams and I would have made simple thoughts. Okay. I'm not aware of this, Mr. Ankur Patel. You'll have to check out with the institute. I'm not aware of it. I'll check up and I'll tell you. There are some case studies given in footnote of the page. Case studies. There is not case studies. I think you are referring to, if you really want to read those citations, wow, you're really great. Huh? You want to read Staples versus Eastman photographic materials. What do you need to do now? You have to go to some legal, it's not worth it, ma. If you really want to do, you can do, ma, but don't do it, ma. It's not worth for you. I don't know why they have given those citations. You want to read the original case law? You are finding it difficult to read even the simplified version in the institute material. This is the original case report as it was originally given. If you want to refer it, the best suggestion is you take it and type it into the Google and search. Automatically, you'll get that case law. Just do it. You'll be very surprised. You just type the name of the case or that 1949 AC 462 HL or preferably the name of the case. Staples versus Eastman Photographic Materials Company. You will get the case law. That there will be some reference to some website where you can go and you can download that case. Okay, I'm Rahul Sharma. No, I'm not going to explain that prerequisite. I don't know. Let's not waste our time because share certificate itself is not very relevant and topic has to be covered. Ma, there are more important topics, Rahul. Allow me to continue, ma, please. If you have a doubt, you read it, and specific doubt, if you have, you ask me, ma. Share certificate, I think we have covered enough and more yesterday, ma. Let's leave it because I have a lot of ground to cover. So let us go there. So calls we have seen. Now we go on to issue of shares at a premium. See, the price, the amount mentioned, just listen to me, you will understand this better. The amount mentioned in the memorandum is the amount mentioned in the memorandum is the face value or nominal value. So in the memorandum, we'll say the authorized capital of the company shall be 5 lakh shares of rupees 10 each. That is called face value. That is called nominal value. Now, when the company is incorporated initially, first time, the shares will be allotted at face value 10 rupees. Let us say that the company has worked some operation for 1 year. Now, at the end of 1 year, the company will get a valuation. Now, minimum the balance sheet, the assets will go up now because profit would have been earned. That would have been added to the reserves and surplus. Am I correct? Bank balance would be there to that ideally. Or debtors will be there, stock will be there, assets will be that profit, additional profit will be represented by assets. So to that extent, at least the value of that company would have gone up. When I issued the share, it would have been 10 rupees. Later on, definitely some profit is added. Now that much, if I divide by the number of shares, I should get that to be added. Now 10 plus another 5 rupees will get added now and all. So there is even more complicated because companies get valued, or when it is issued to the public in the market, there is a perception of that company. Based on that, the price of that company share will be there. Based on all this only, the premium is fixed. The premium is the difference between the issue price and the face value of a share. So when I'm saying that the issue price is 250 rupees, what I mean is 10 rupees is the nominal value, balance 240 rupees is securities premium. Okay. Now, this extra amount I'm getting now, 240 rupees, it belongs to the existing shareholders. Please understand it. It belongs to the existing shareholders, or it belongs to the owners of the company. So when a new person wants to come in, he can't come in at 10 rupees because I have come in at 10, I have worked hard, our investment was there, it grew. Today it is at this stage. Now you want to come in, pay this price and come. So that amount which is collected belongs to the existing shareholders, or it belongs to the shareholders. It cannot be used for any purpose other than fixed by the law. So what they're saying is, when shares are issued at a premium, the amount of premium received shall be transferred to an account called securities premium account. So whatever is the premium, for example, when I'm making an entry, I will say share application account debt, bank account debtor to share application money account. All the money is coming in. Then allotment is made. At that time, what entry I will pass? Share application money account debtor to share capital, which only the nominal value means. In our example, share application money account debtor 250 to share capital 10 rupees to securities premium account 240. So whatever is put in that securities premium account will be treated as if it is part of the paid up share capital. It will be locked. That money, the purpose of this provision is to prevent utilization of premium on issue of shares to pay dividend. So one thing you will have to very clearly understand and appreciate and accept is that securities premium account cannot be used for paying dividend. Got it? No. So it cannot be part of free reserve. Whenever they want to include it, they will separately add. When you come to buyback, they will specifically say free reserves, securities premium account separately. Okay. Otherwise, security premium account is a sacred fund. So what purposes can securities premium account be utilized? 5 matters only it can be utilized. I'm sure you know it by now because you might have studied it in CPT. For accounting, not in company law, but in company accounts, you might have studied it. Because when you are learning issue of shares, accounting for issue of shares, at that time they might have taught this to you. So this is well known to you. So securities premium account may be applied by in fact, from now on, the topics we are going to study now, there will be a lot of link connection between this topic and your accounting, financial accounting, or whatever you call it, advanced accounting, or whatever the name is being given, that topic, corporate accounting, this and that will be very low because entire corporate accounting is based on Companies Act. So the accounting rules will be influenced by the law, legal rules. So you will find that there are a lot of connections. Okay. Yeah. In a way, Honmane, you are very correct, Ruturaj Honmane. This is similar to the goodwill. Exactly. The extra profit you give it to us. Then you come. Thereafter, together we will share them. From that time onwards, we will all be together. Whatever we make, you will also be entitled. But till now, what has been made, you bring it, you pay it to the company like that. Now, the securities premium account can be used only for 5 matters. What are they? First, towards the issue of unissued shares of the company. Issue of unissued shares of the company to the members. It is part of authorized capital, but it has not been issued. Now, what you are doing, you are issuing them to the members as fully paid bonus shares. You are issuing them to the members as fully paid up bonus shares. That is, they are not paying anything, but they are getting shares. This is called bonus shares. Later on, we'll be talking about issue of bonus shares, separate topic. But one of the sources for issuing bonus share is security premium account. You can also issue bonus shares out of profit and loss account, general reserve. Any reserve which is available for declaring dividend, free reserve, you can use it for issuing bonus shares. You can also use securities premium account for issuing bonus shares. Okay. Also, you can use this securities premium in writing off the preliminary expenses. Preliminary expenses are the expenses incurred for forming the company. Even before the company is formed, you have to spend the money now. The promoters will spend it. That money at the first board meeting, we will ratify it and we will take it into the books and we will reimburse them. That will now be debited to preliminary expenses. That preliminary expenses is a capital expense. It cannot be written off to P&L account. It will be in the balance sheet. From there, if you want to remove it, you can use it for issue of shares at a premium. In writing off the expenses of or the commission paid or discount allowed on any issue of shares or debentures. So issue expenses, in your institute material, you will find the word issue expenses. That is expenses connected or expenses of any issue of shares or debentures. So when you go for issue of shares or debentures, there will be a lot of expenses. You have to pay fees to the merchant banker, the lead manager. You'll have to pay fees to so many expenses will be there. And printing cost will be there. Advertisement cost will be there. Also, you would have paid commission to the brokers. Underwriting commission will be paid. Commission will be paid to the brokers for selling. Underwriting commission is additional, only for those people who underwrite, and so on and so forth. All that can be written off. Normally, what we will do, we will take the issue expenses and we will write it off over 5 years as a deferred revenue expenditure. But if you have security premium account, in one shot, you can remove it. Okay. Till it is fully written off, where will these expenses sit? To the extent that it is not written off, it will go to the balance sheet. On the liability side, it will be shown as a negative item. It's a debit now. When I'm incurring expense, debit all expenses and losses now. So I would have debited it. So that debit means it should either go to the P&L on the expense side, or it has to go to balance sheet on the asset side. But how can I show it under asset? There is no space there. Earlier, in the old format of balance sheet, under Schedule 6, there used to be something called miscellaneous expenditure and losses. There will be a separate column on the asset side, miscellaneous expenditure and losses. Now it is not there. The new format of balance sheet under the Companies Act 2013, which I'm sure you are familiar, Schedule 3 format, it is not there. Instead, what you need to do, these items which are basically debit balances will have to come to the liability side. Now, liability side, only credit will go. So, if you are bringing a debit there, you have to show it as a minus. So, under reserves and surplus, we will show this as minus, less preliminary expenses, minus commission issue expenses. Now, instead, what you can do, you can adjust it against security premium and finish it off. You can use it for writing off. Also, you can use it for one more thing you should understand. Here they are saying commission paid or discount allowed on any issue of shares or debentures. So at the time of issue of debentures, you might give a discount, meaning you might issue 100 rupee debenture, 10 rupees discount, meaning the debenture applicant will pay only 90, but we will credit 100. So I will pass the entry bank account debtor 90, discount on issue of debentures account debtor 10 to 12% debenture account. Later on, when at the time of redemption, I will pay him 100. So that's kind of benefit for him, 10 rupees discount. So that discount is a cost. Now, normally it should be taken to balance sheet and written off over the life of the debenture. So if the debenture is to be redeemed in 5 years, over 5 years, we will write it off. There are many methods of writing off, whatever. But if you have securities premium, straight away you can write it off. Means credit, discount on issue of debentures, debit security premium. Matter over. Also, at the time of redemption of preference shares or debentures, you may pay a premium. That is, today when I am issuing the preference share, I am issuing it at 100 rupees. 5 years later, when I am redeeming it, I will pay 110 rupees. That 10 rupees is called premium on redemption. It is again a capital cost. It will be accounted at the time of issue. When it is actually incurred, it will be adjusted. Okay. So that amount also can be written off against it is a cost. Okay, it is a cost. When you are redeeming the premium preference shares, now you will pass the entry preference shares account debtor, premium on redemption of preference shares account debtor to preference shareholders account. So preference share will get closed. Premium will be a cost, debit. That you cannot take it to P&L. It is a capital item. You cannot take it to P&L. It is not revenue. So it has to come to balance sheet. Again, minus. That you can set it off against securities premium account. Lastly, securities premium account can be used for the purchase of its own shares or other securities for buyback. So when a company goes for buyback, the buyback can be made out of securities premium account. Okay. More when we come to buyback, again we will discuss what this is, right? So thank you, Ms. Mansi Gupta. Occasionally you keep putting this type of comments which make me a little happy. Okay, now this is very interesting and important also because, friends, the companies which are not listed, unlisted companies, they will come under the control of MCA. Listed companies will come under the control of the SEBI. Okay. Now what that rule 3 says, unlisted companies, private companies, and listed companies may apply securities premium account in paying up unissued shares of the company, in writing off the expenses or the commission paid for the purchase of own shares or other securities. I really don't know what this is. Does this mean that listed companies can do only for these 3? See, in addition to that, there are 2 more now. See, in addition to issue expenses, preliminary expenses is there. And premium on redemption is there. These 2 heads are not here. My understanding is listed, say they are saying unlisted companies, private companies, and listed companies may apply. So, does rule 3 mean that these categories of companies can only do these 3? Unlisted, all are unlisted. If they are not listed, they are unlisted. So, does rule 3 mean that we are restricting this to only these 3? Is that the scope? I am unable to answer it. Okay. So, they have also given it in your, if you will find it in 4.24 of your Board of Studies. Subsection 3 has overriding effect over 1 and 2. Okay. And it restricts it. That is this subsection 3 is this. It has overriding effect, which means what? In the case of certain classes of companies, you can do this. But rule 3 says unlisted companies and all. Okay, I am informed that this is applicable only to listed companies. My understanding is that listed companies means which are listed, subject to SEBI regulations, can apply securities premium only for A, B, and C. They cannot apply it for preliminary expenses and providing for the premium payable on the redemption of preference shares and debentures. So this is the meaning of this. So this is applicable to specified companies. Okay, but basically listed companies. Okay. So that is what we have to understand. Meaning, actually what they are saying is, where a company is a listed company, or has to compulsorily apply the accounting standards. When they are doing that, then this cannot be used. Okay. I don't know what they are trying to do. So this is only for specified companies. Other companies can do this. Okay. Whose financial statements comply with the accounting standards prescribed. So there are still some companies for which the accounting standards is now applicable to all companies, irrespective. So that is why unlisted, everybody has to go They can. So we can only go for, if you are applying the accounting standards mandated under section 133, then only you can apply it for these three purposes. You cannot apply it for B and D. This is the meaning I am getting out of this subsection 3. Okay. Thank you, Ms. Mahanti, about my English. Thank you. Promotional expenses like promoters, not promoter's salary. Promotion expenses, meaning money spent for incorporating the company, lawyer fees, auditor fees, registration fees. Such things are called preliminary expenses. Okay. And promoters don't get any salary. Advertisement will come under issue expenses. In issue expenses, advertisement and all will come. In some of our accounting plans, financial state, we enter in other expenses, in P&L. Maybe, see, because they are specifically for listed and accounting standard-based companies, you are not going to use securities premium for that. So, see, you can write off preliminary expenses. You can write off preliminary expenses, but you cannot do it in one shot into the balance sheet. You can write it off over 5 years or 10 years like that. That can be taken to P&L. Nothing more. That can be taken to P&L. But if you are going to write off the entire preliminary expenses in one day, I think there is one view that the entire preliminary expenses can be written off in that year itself like that. I don't know. According to me, that will be matching concept violation because preliminary expenses is for forming the company now. It will have a long-term impact, right? So you can take it. I am sorry, I may be wrong. Vaishali Bindal, you are right, ma. I think ultimately these MCA, crazy fellows in MCA, bottom line, what they are trying to say is you can use it only for these three. I also agree with you, Ms. Vaishali Gupta. I think your opinion is, I confirm your opinion. Okay, where is Vaishali Bindal? Sir, according to me, you mean only that three we can use it. Beautiful. In future, you will make a very good chartered accountant because, see, one of the things that only chartered accountant can do is to express an opinion. See, when I audit a balance sheet, I'm auditing facts. But when I give a report, I'm giving my opinion. According to me, in my opinion. So you are now telling, according to me, in my opinion, like that. I agree, I concur with your opinion. The crazy people in Ministry of Corporate Affairs, in their own long-winded way, what they are doing, they are having 1 and 2. In 1 and 2, they are doing something. Then they are having 3. By 3, what they are doing, they are restricting that to 3 items only. Only these 3 items. Why? Because, see, almost all companies are subject to accounting standard. That means that any company which is subject to accounting standard can use securities premium account only for these 3 purposes. Yeah, why I am giving it? Because today, see, unlisted company, private company, listed company completely covers every company. It covers everything. So effectively, what Vaishali Bindal says would be the correct view. All companies which are adopting accounting standard will have to go for this. Okay, that is what it means. Is there a limit on number of times issue at a premium? Nothing. No limit every year. If people are willing to buy, please issue at a premium once in 3 months and enjoy. Okay. Okay. Is it possible that unlisted company issue share to public in any way without private placement? Is it possible that unlisted company issue share to public in any way without? If it does that, it will be a violation of Section 42. It will be a violation of Section 42. Please. If you think there is any method, you educate me. I'm not able to think of. Private placement is there. Use it. Rights issue, yes, but that is not public. You're going only to your own shareholders. Right. And that Kundangulam case law is there. No, Kerala High Court case. What are they saying? In case you go for a rights issue with right of renunciation, if that is more than 200, that will become a deemed prospectus. So there you will be violating it. So I don't see a method of doing it. But if you still feel there is some method, do research and educate me in the next class. I am not able to think, but if you have come across some method, please share. And to improve our knowledge, I will, if it is a good idea, we will share it with everybody. I have not come across. Overriding effect means like notwithstanding. Yesterday we spoke now, notwithstanding. See, 1 and 2 are speaking in one way. Now 3 suddenly says, certain companies can use it only for these 3. Na? That means what? 3 has superior to 1 and 2. Overriding effect means this subsection 3 is superior to 1 and 2. That's what it means, overriding. Okay, so when I give an instruction to my driver, then my wife is giving another instruction. Her instructions are overriding me. Meaning what? Driver should not obey me, what I say. He will only obey her. It's called overriding. Whatever I say, no, notwithstanding what I have told, what my wife has told only will be valid. This is called overriding effect. So 1 and 2 will speak in one language, which is these 5 matters. Now 2 speaks about these 5. Now 3 says, go. No need to do it like that. So, welcome to the crazy world of the Ministry of Corporate Affairs. Why they cannot simply amend 2 and include only 3 matters? Yeah, simplify it. No, make it confusing so that people will not know what is what. Then they will violate it. Then punish them. Wow. To my knowledge, preliminary expenses are long-term, but of late they are being treated as short-term and written off in that year itself. So choice is yours. It's as Vaishali says, no, it is an opinion issue. My opinion. Finally, what the law says is final. Law has nothing to say about it. You know what I mean? See, whenever you use a terminology that I have not taught, I will ignore that question. You are using CRR. CRR I have not yet taught. When I teach, at that time we will discuss. When we come to CRR, at that time we will discuss. If I should waste my time explaining what is CRR, which I am going to do later. So hold your question. According to me, CRR is used first for redemption and preliminary expenses. Okay, use it. What can I do? Use it. You are going to use CRR for redemption and preliminary expenses. I don't understand you, Ms. Juvatkar, Prajakta Juvatkar. I'm not able to understand what you are saying. First of all, let us talk about, as a teacher, you are a highly intelligent student. Just wait. There are a lot of people like me who don't know anything. First, we will discuss what is CRR. Then we will decide whether your opinion, etc., is correct or not. According to me, all you people are great, yeah. You are so clear about your opinions. Whereas, 35-year-old practicing chartered accountant, I'm unable to give opinion the way you are giving. According to me, CRR, first for, I'll keep it written so that I'll come back to it, and preliminary expenses. What is that? Juvatkar. We'll see. We'll come to CRR. At that time, we'll discuss. Miss, what is that? What Juvatkar? Prajakta. Okay, no problem. We'll do it. We'll take it up. Okay. Now we come to discount. So, discount is when a share is issued at a price below its nominal value. Premium is when it is issued above. 10 rupees share is issued at 25 rupees, 15 rupees premium. 10 rupees share is issued at 8 rupees, 2 rupees discount. So, this is the difference between the face value and issue price, which is capital loss. The issue price is below the face value. Now, first of all, issue of shares at a discount is prejudice or is not good. It will affect the creditors. Why? Because, think about it. When I'm issuing it at a discount, I am getting only 8 rupees. But I'm crediting it at 10 rupees. At the time of liquidation, the shareholders will get 10 rupees. So they will get more than what they paid. So this is not good for the creditors. Therefore, the general rule is that company shall not issue shares at a discount. So section 53 gives a general prohibition regarding issue of shares at a discount. General prohibition. So basic rule, shares cannot be issued at a discount. Any share issued by a company at a discount price shall be void. Okay, immediately. Sir, is there no exception? Yes. There are two exceptions. First exception we are seeing now. There are two exceptions. First exception we are now seeing. That is, shares may be issued at a discount to creditors when its debt is converted into shares in pursuance of any statutory resolution plan, or debt restructuring scheme in accordance with any guidelines or directions or regulations specified by the RBI. I'll give an example. There is a company, let us say Debentures Limited. It has borrowed heavily from the bank. It has reached a stage where it is not able to repay. Okay, they are not servicing the interest. Bank is going to go for insolvency. So in the meantime, these fellows go to the Reserve Bank of India and they say, sir, we are all having employees, this, that. Kindly help us to revive. Give us a restructuring scheme or a statutory resolution plan. So they may either go to RBI or it can be even done under the guidelines of the insolvency board. Whatever it is, based on the guidelines or directions specified by the RBI, if a restructuring scheme is coming, what will happen? The banks and all will be called for a meeting. We are not talking about 1 rupee, 2 rupees here. We are talking about 500 crore, 600 crore, Nero Modi level. So all the banks will be called for a star hotel meeting. When they will come, they will be told, totally we are owing you 500 crore rupees, including interest to 550 crores. Sorry, we cannot pay. Straight away. RBI has told us we need not pay. You might have read in the newspaper now, Indian Bank takes a haircut. State Bank of India takes a haircut. Have you heard this haircut? This is called haircut. What does it mean? It means in Tamil Nadu, if you come, full haircut we give. We shave the head. We call it mottai. We put mottai. Instead here only mild haircut we do. We tell him, boss, we owe you 500 crores. We cannot pay interest. It's another 50 crore. Balance 450 crores. I cannot service it. I will convert it to equity shares. Take it. So compulsorily that loan under that scheme will be converted into equity. Now, at that time, the bank will tell, hey, Baba, be reasonable, ma. At what price are you going to take it? No. You take it at par only, 10 rupees only. Hey, how can you take it at 10 rupees, man? Your company has been incurring loss. Up to minimum today's value is only 5 rupees. How for 5 rupee value company, why I should adjust to 10 rupees? What happens now? 4 crore 50 lakhs, 450 crore is due now. To find out the number of shares, what I will do? I have to pay them 450 crore balance. Finally, settlement. I don't have money to pay. I am telling I'll give you shares. Now, what price I should take? Let us say I take 10 rupees, then 450 crore divided by 10. They will get some number of shares. But they are telling, Baba, your share is not worth 10 rupees, ma. It is less than nominal value. You are a loss-making company. Why I should adjust to 10 rupees? You make it 8 rupees or make it 5 rupees. Negotiation will go on. Finally, the company will say, okay, I will give it to you at 5 rupees. Take it. So 450 divided by 5, not 10. Now, forget the number. Logic. 450 divided by 10 will be more, or 450 divided by 5 will be more. 450 divided by 5 will be more. Nah? So the bank will get more shares. This will compensate them for they are foregoing the interest, no? And they are foregoing even some principal. So for that, there will be some amount of compensation. See the creditors and all, they are entitled to interest. They are going to forego it. Forego means give up. Okay? And they are taking a haircut. And they are accepting shares. More risk. No repayment. If at all the company does not do well, full 3 lines, vertical lines on the forehead. So such a risk they are taking. Therefore, that discount will compensate them for the interest forgone. Okay? I have given a practical example. Maybe if you're not able to follow my language, it's very difficult. But with the example, we can understand it easily. Exactly. I'm using that to explain. Whenever I give an example of a company which is not honorable or honest, I will use the word Dubago Limited. So don't think that it is bad word and all. It is a Tamil word which we use in Tamil Nadu, meaning fraudster. See this company, is it an honorable company? It has borrowed money. Done, I don't know how, for all you know, the promoters might have siphoned that fund. Now they are not able to repay. Now they are saying, I will not pay you interest. I will not pay you principal. For 500 crore, I owe you. Only 450 I will pay. That also I won't pay. I will give you equity shares. Okay. See, when you do fraud at a small level, no, you will get caught. When you do fraud at a big level, you are like Nirav Modi, etc., etc. You can command the banks and do whatever you want. It's only the guys who do small frauds, they get caught. The big fraudsters, they do it officially. Which type they will convert, preference or equity? That is choice, but equity also they can do, preference also they can do. Not a problem. Ideally, they will take equity so that they will get control over the company. You see, they may take partly preference, partly equity. All that will be part of the restructuring scheme. There is no rule. See, this is where your role as a finance professional will come. You will have to structure it. You will have to go to if you are employed by this company, and I hopefully not, but let us say that you are employed by this company as a consultant, then you will have to prepare that scheme and approach the Reserve Bank and get it approved. At that time, you decide which is best for you. Also, the bank will also tell, I want equity so that I will get stake. See, what could happen, even though the company may be doing loss, it may be having good market share, maybe mismanaged. So what the bank will do, once they get that stake, let us say they get about 30% of the paid up share capital. So quite a good stake, Baba. So they will get into the board also, and they will try to control the company, or else they will threaten the management and say, look here, 1 year down the line, if I don't see profit, you will not be MD. I will appoint somebody else as MD. All that will happen. So equity is better because it will give you control. Whereas preference shareholder cannot vote now. So no control. Okay. It depends on the company now. I'm assuming, see, I'm giving 450 crore. For all you know, the company's assets may be worth 2,000 crores. Are you able to understand? There may be other lenders also. So it depends. They might even take over the company. Why not? They might even take over the company. They might give a smaller share to the promoters and take 80% share and keep the promoters as for running the company. Or they might take preference shares. They might say that you run the company, we will have preference share, redeem it after 5 years and give me dividend every year. Depends, yeah. See, this is where law stops and management begins. Okay, your law, that's when the role starts. The law is there only to provide a framework. Now, if any company is issuing shares, other than this exception, you cannot issue shares at a discount. If a company violates Section 53, then there's a penalty equal to the amount raised through the issue of shares. Means you will have to refund the money to the members through the applicants. Plus, suppose you have raised 20 crore by issuing shares at a discount, then you have to pay it back to them. And you have to pay another 20 crores as penalty, or rupees 5 lakhs, whichever is less. So minimum you have to pay 5 lakhs. Okay. Though they have said equal to the amount raised, they've reduced it to 5 lakhs. Maximum is 5 lakhs. Also remember, in addition to the penalty, the company shall also be liable to refund all monies received with the interest at the rate of 12% per annum from the date of issue of such shares to the persons to whom such shares have been issued. Okay, so this is now I said there are 2 exceptions for issue of shares at a discount. Okay, one exception we saw, this one. Second exception is sweat equity shares. Sweat equity shares. Okay. Now, sweat equity shares is a concept. Idea is the word sweat. See, sweat is what? In Hindi, what do you say? Qanun is blood. What is sweat? I forget the name for sweat. Okay, Qanun, I think Qanun is blood, right? I don't know what is sweat. sweat is basically the efforts taken by the employees and directors. We want to reward them by giving shares. So sweat equity shares means shares as are issued by a company to its directors or employees. Both the directors and employees are eligible for sweat equity shares. Please note, sweat equity shares can be issued at a discount. So this is the second exception. Sweat equity shares can be issued at a discount or for consideration other than cash. So you can, pasina, correct. Coon pasina. There was a coon, right? Not kanun, coon. Coon is blood and pasina is sweat. Correct. Coon pasina, I have seen, I think there was a movie. Yes. So, no, I'm trying to learn Hindi words, but Buddha ho gaya na, so how much I can learn? There's a limit. When youngsters like you at 25, 22 are not willing to learn English, this old man, how he is going to learn Hindi, you tell me. So, sweat equity share means such equity shares as are issued by a company to its directors or employees at a discount or for consideration other than cash. Meaning what? I am an employee. I'm working hard in the company. Now, I'm knowledgeable about the company's process. So one day I find that if one type of approach is taken, there will be saving in cost. Okay. Now, the company comes to know about it through the management. They are so happy. They implement the idea and the company is getting a lot of, shall we say, financial gain. How? Because some simple idea that they gave, if they implement, I'll give you an example, you will understand. In the Goodyear tire company, one of the workmen, he had this wonderful idea. He said, see, the tires, will have tread. The outer edge of the tread will be very costly nylon rubber, nylon tire cord. Inner part, which is nearer to the hub, will be lesser quality. Now, what they were doing, this Goodyear, they were having a thickness which is in mm, which is pretty thick. And they were giving the tires with the costly material on the outer rim. Now, this workman found when the tires came back for retreading, see, once that outer tread is over, it come for retreading, he found many tires, even after 3 years, 3.5 years, the entire costly rim part now was not getting affected. So he went to his manager and said, sir, why are we putting so much thickness? Why cannot we reduce the thickness by at least, he gave 1 mm or 2 mm, let us reduce the thickness. It won't make any difference because by the time the tire becomes old, it would have reached exactly that place. They will return it back and will. So they started analyzing it. So they made it less by 2 mm. So 2 mm thickness means the entire partners, that imagine it, entire strip savings of material. They calculated number of tires per annum. It came to a huge amount. Per month, it came to something like 40 lakh savings in buying in rubber cord tire. So they found this was so great. So they gave this guy, they want to give this guy an award. Now, of course, they can give him 1 lakh cash, 2 lakh cash, whatever. But instead, they are thinking, hey, let us make him a part of our company. So let us give him a share. So they can either give it to him at a discount, meaning they can say, look here, our share, Goodyear share is now quoting at in the market at 450 rupees. We will give it to you at a discount. Discount means on nominal value, not on issue price. Okay. So they might give it at a discount. Or they might say, look here, we are giving it to you for consideration other than cash. You don't have to give a pie. They will enter into an agreement with him, but they'll be very smart. They will say, we are allotting you shares worth 5 lakh rupees for consideration other than cash. I hereby agree. That employee will say, I hereby agree that all the intellectual property belonging to this idea now belongs to the company. Straight away, he'll give it over to them. And so they will give him shares. What entry they will pass? Intellectual property account debtor to share capital. Straight away. Sometimes they might give it to employees who are working hard. So, for example, they might say you have to produce a target of 2 million units. So they struggle hard and produce 2 million units. So each of them gets 100 shares as a reward. So basically, this is employee compensation. So the employee compensation expenses accounted are to cash. To share capital like that. Now, another example could be, there is a man who is a scientist. He is working in some government agency, but he is doing independent research in pharma area, where he has now discovered a very beautiful formulation which can cure, or which is an antidote for the very, very complicated new virus that has been discovered. So the pharma company knows that if this formulation is with them, they can make millions of money. So the scientist also knows it. So when they comes for the discussion, he will say, look here, I cannot give it to you just like that. You have to give me lump sum so much crores. Also, you have to give me 10% stake in your company. And you have to make me a director. So we make him a director, then we give him sweaty equity shares. Okay. So he hands over the intellectual property to us. So why are we giving them these shares? For know-how or making available rights in the nature of intellectual property rights or value additions by whatever name called. So ideally, when you are allotting sweaty equity shares, you should have some contract with that person, agreement, by which you will say, I am giving it to you for this purpose. So, and that whatever is that head, to that head, you will debit the amount, credit share capital. Sweaty equity shares can be issued at a discount. Okay. The word value addition is also defined. It is any economic benefit, actual or anticipated economic benefits derived or to be derived by the company. I have given the example of Goodyear. By this idea given by that man, the company has saved money. Now every year they are saving 40 lakhs. It's a great, I think every month, every year they are saying 4 crore 80 lakhs. It's a fantastic amount now. So it is an anticipated economic benefit from an expert or a professional for providing know-how or making available rights in the nature of intellectual property rights by such person. Note, consideration for value additions are not to be paid or included in the normal remuneration payable under the contract of employment. So this should be over and above. That's why I gave you that example of a group of people who are achieving 2 million target now. So that is over and above their salary, we are giving them this. Okay. Employee means permanent employee who has been working in India or outside India. A director of the company, whether a whole-time director or not. So our pharma guy, we may not making a whole-time director. We will make him part-time director. But once he is a director, we'll have. An employee or a director as defined in subclauses A or B above of a subsidiary in India or outside India or of a holding company. So employee or director need not be in this company. He can be in a subsidiary. Such subsidiary may be in India or outside India. But holding company means it should be only in India or a holding company or of a holding company of the company. Okay. Specifically outside India is not there for holding company, right? Manoj Yadav wants to know if sweaty equity shares is equal bonus share or ESOP. Bonus is totally different, man. First, you understand what is bonus. Anyway, I'll come to bonus. Bonus means all shareholders will get, not only employees. Suppose I'm giving bonus share, two bonus shares, one share for every 2 shares. All shareholders will get, including employees. Non-employees also will get. So, have I proved to you that sweat equity shares does not mean not equal to bonus, because sweat equity shares will be issued only to, note my words, only to directors or employees. Whereas bonus, once announced, everybody will get it. Okay, so it is not bonus. ESOPs are slightly different. Please understand. We will be seeing ESOPs a little later. Employee stock options are given by a company to all employees. Please note, ESOPs are announced, the scheme is announced for all employees, whereas sweat equity shares are given to selected directors or employees. Sweat equity shares are given to selected directors or employees. So it would not be correct to say that ESOP shares are, sweat equity shares are ESOPs. Sweat equity shares are not bonus. They are totally different category, clearly defined. Only this way it will be. So they are alag. So you have to somehow wrap your mind around this concept that sweat equity shares are not ESOPs. One more thing, ESOPs are given to all employees. ESOPs cannot be given at a discount. ESOPs cannot be given at a discount. Sweat equity shares can be given at a discount. One more thing, sweat equity shares are given as some kind of a consideration for making available rights. ESOPs are given for everybody based on service. At best, what you can do, you can say people with longer service will get more shares. People with lesser service. Also, higher in the hierarchy, top management will get more ESOPs. Smaller level, you will get less ESOPs. Such distinctions of classes can be made, but all employees should be given. Every employee who qualifies should be given. Whereas in sweat equity, I'm cherry picking and selecting employees and giving to them specifically to selected employees. This is one important point that you should understand. Have you understood, Manohar Yadav? It's a good question, and I hope you have understood. So they are totally different. Bonus is totally different. See, both in ESOP and sweat equity, there is some consideration. For ESOP, what entry I will pass? Employee compensation account debtor, bank account debtor to share capital. Sweat equity, what I will pass? Intellectual property account debtor, employee compensation account debtor to share capital. Bonus, what entry I will pass? I am only capitalizing reserves. So general reserve account debtor, capital redemption reserve account debtor, like that. So these are P&L account debtor to share capital. In the same balance sheet, from reserves and surplus, I'm kicking it up to share capital. That's all. Okay. So I hope this explanation would be of use to you. Have you understood it, Mr. Manohar Yadav? Yeah, once the shares are allotted, whether they are sweat or ESOPs, they are entitled to voting. Why not? They are entitled. They are also entitled to vote. Okay. But it's a good question asked by Manohar Yadav because many students have the reason the doubt comes is sweat equity also given to employee, ESOPs also given to employee. So confusion. But bonus, you cannot confuse. Bonus totally alag. It's totally different. Okay, procedurally, you can go. I am giving in a simplified form. If you want to write like this, you can write. If you think it is not good, don't write like this. But in the exam, when you go and sit now, you need to remember it, right? Once you remember, automatically you'll write. For that purpose, I'm giving in simplified way. If I put the entire board of studies here, you will all go to sleep. Okay, that is not the idea. I'm taking a sentence and keeping it simple. So some of you will have doubt. Sir, if I write what the way you are put, will I get marks, or you may not get, sir? So you choose, sir, what you are going to do. But simplified writing is always better than, see, you should write in simple words, but some keywords you should not change. Some keywords are, so those keywords here also I'll put it. The keywords you should not change. Okay. When the keywords come, I'll be emphasizing the words. Sometimes I'll put it in bold, like that. So that should never be changed. See, what you will do, you will mug up the institute material, but where it is ordinary resolution, you will put special resolution. You will lose. Whatever you write, where the resolution is an ordinary resolution, if you put special resolution, you will lose marks. Even though you might have mucked up the material and vomited it there, that crucial point is what the examiner is looking for. Do you know that a special resolution or whatever the resolution has to be passed? That you have to write correctly. That is what you are getting marks for. So, in an answer, while setting a question, we would have said, hey, we expect the student to write these 5 points. If these 5 items are there in the answer, it will get 4 out of 5. If the handwriting is good, 4.5. Or if the person has quoted section numbers, etc., 4.5. So this is how that. But if one point is missing, reduce. If one very, very crucial point is missing, then whatever you write, you will get only 2. So I'm giving this to you not to confuse you, but to help you to understand how answers should be written. To the point, clearly building 1, 2, 3. See, this is not university exam. You cannot write gas, simply gassing around. If you write pages and pages, you won't get marks. In the university exam, yes, once in my BCom exam, the question was, write the procedure for winding up of a company. I'm not joking. I wrote 12 pages. Complete, from passing of special resolution right up to going to court and getting the order of the court. Completely I wrote 12 pages, and I quoted sections. Okay, of course I got 92 for BCom. My BCom law mark 92. Obviously, na. See, BCom level pass. So there it's a different approach. They want you to write. In the institute exam, if you write more, you won't get marks. Every line, paragraph should add to the conclusion. Then conclusion. Which is why they have totally stopped asking you basic theory questions. What are the matters for which securities premium can be used? They won't ask. No. They might give you a problem where they will test you, whether you are aware. So one question they might ask to catch you out is, they might say that the company has to comply with accounting standards. Then they will ask you, what are the purposes? Then you should be careful. You should write only the 3 items, not the total 5. Okay, like that. Okay, I'm just giving this to you, not to waste your time or to irritate you, but to help you understand how law paper should be approached. Some students have come back to me after clearing the exam and said, sir, these insights were very useful to us. So because they have told like that, I'm taking the liberty of sharing it with you. Though some of you may get angry, irritated and say, why are you wasting my time? Go on to the topic, which I will now do. Okay. So the important points to be noted are, the shares are to be or should be of a class of shares already issued. Meaning what? If preference shares are not already issued, you cannot issue now. So already issued, only then you can issue now. You can issue certifications. A new class, in other words, the preference shares are not there in your memorandum, or even if they are there, they have not been issued, then you cannot issue. There should be an authorization by special resolution for sweat equity. Listed companies should, in addition to this, comply with SEBI regulations. Why SEBI regulation? Because, see, when the company is already 20 years old, how to value that share? See, I'm going to give them certain equity shares. Now, at what price I have to give? You can't give it at any price. If it is a listed company, SEBI regulations are there. Very clearly, they say 21 days. You have to see what was the price fluctuation. Based on that, that's a separate rule. You need not know it. Okay, is the point. You need not know it. And to the extent that institute material has rule 8, my suggestion, you go through it. You go through it, which is rule 8 is given here. It's given here. But whatever I've covered only, you need not worry. And you can, okay. Now, sweat equity shares will rank pari passu with other equity shares. What does it mean? It means to the extent that sweat equity shares have been issued, they will have the same rights as other equity shares. For example, somebody was asking about voting. They have the same right, voting rights. Class of shares means preference share is one class of share. Within the preference share, 12% preference share is one class. Like that. Equity share is, normal equity share is one class. Equity shares with differential voting rate is another class. Like that, we have class of shares. Have you understood? Okay. What if the amount of loan taken is more than the number of shares available to a certain? Issue more shares, ma. What to do? You do the computation. If it is more than the number of shares available to us for paying up, you issue more shares. You amend your article, you amend your memorandum, increase the authorized capital. What to do? Okay. You amend your memorandum, alter the capital class, increase the authorized capital. Now you allot. Pari passu means in proportion, equal proportion, unequal. So rank pari passu means they will be having the same rights as the equity shareholders. For example, I told you, so there will be, it is not as if normal equity shareholders will be superior to sweat equity. Both sweat equity and normal will be at par. Okay, you can say they will be at par. Okay, in this meaning. Got it? The sweat equity shares shall be locked in for 3 years from the date of allotment. Okay. The sweat equity shares should be valued at a price determined by the registered valuer. Okay. Now, so there is a maximum limit for issue of sweat equity shares. It is given in your material. 15% of the existing fixed equity share capital or shares of the issue value of rupees 5 crores. So in 1 year, you cannot issue more than 15% of the issued existing paid up equity share capital or of the issue value of rupees 5 crore. Okay. So basically this is sweat equity share. So I might have mentioned preference share. You cannot issue preference shares for sweat equity. Only equity. If somebody asked whether preference can be issued and I have told yes, it is not correct. Basically only equity can be issued. And once I issue equity shares, they will have the same rights as the other equity shareholders. Okay. Now, good. Moving on. We are moving to another important topic called redemption of preference shares. Time now is 7:25. I think it's a good time for a small break. When we will have a small break. And before that, Manish Kumar is asking, can we amend the face value of a share? We can. I will tell you how it is done when we come to alteration of capital. There is a topic here called alteration of capital. When I come to that, I will tell you about it. Now, I will only tell you, yes, it is possible. You can take a nominal value 10 rupee and you can subdivide it into 1 rupee and all that. Or you can consolidate. You can take 5 10 rupee shares and make them 150 rupee share. Whatever. It is possible. But that is another topic I'm going to talk about called alteration of capital. Okay. So we are moving on to your issue and redemption of preference shares. 5 minutes break. 5 minutes. Thank you. Welcome back from your tea break. And just I thought, a little bit of break. And let us see if you have any more questions before I move on to... can we amend? I will start to company have to take assent of the existing members in order to issue shares at a discount in the case of restructure. A good question. Restructuring, see, when the restructuring is happening as per the RBI rules, there is nothing in this law, but in that rule there might be. Generally, it's good to take consent of the shareholders. But you see, anyway you are going to issue shares now. Issuing of shares, there is no need for share resolution. It can be done by the board of directors. There is no need for a resolution by shareholders. For your information, there is no need. But still, if the RBI is insisting, they can. Basically, for issuing shares, there is no need for any resolution. Okay. Is MCA website company shows strike off? What it means? It means that company has not been functioning for some 2 years like that. And the registrar is feeling that it is no longer functional, defunct, D-E-F-U-N-C-D, defunct company. So if the defunct company will be seen as strike off. That means the name of the company has been struck off the register. It's no longer a valid company. It's a defunct company. Again, not in your syllabus. Don't waste your time. But it's general knowledge. Discount on nominal value will be too small. What they will do, they'll give a discount of 2 rupees on nominal value and 20% on the issue price also they'll give it. They will give it at a slightly lower price than the market value, usually. Even ESOPs, they will do that. See, ESOPs, compulsorily the company will give it at a price which is below the market value. Only then the employees will buy. Or if the market price of the share goes up above their strike price, they take it. Otherwise, why should they do? When the market itself is available lower, why they will take from the company? They'll buy from the market itself. This happens in ESOPs. Then later on. But remember, suppose the market price of the share is 200 rupees and you are giving it to the employee, whether sweat equity or ESOP or whatever, market price is 200 rupees. Quoted price in the market on that day is 200. You are allotting to him at 150. That extra 50 rupees is an income in his hands. If it is an employee, it will be treated as perquisite and it will be taxed in his hands. On the date of allotment, even though he has not sold the share, it will be treated. You can check it out. Perquisite value. Income tax. So that is also there. So if I give it to him below the market price, he still has to pay tax on that. But at the time of actually selling the share, that the price at which is allotted to him, the market price on that day, because he has paid tax now for that. The balance portion he has paid tax now. So when he sells it, his cost will be taken as the market price on that day. And so on and so forth. That's an income tax concept, but I'm just saying. Section 17 and rules and all. If one company name is removed from register of companies, then using same name can incorporate. Yeah, you can. If that has been removed, yes, you can. It can be done. See, we had one company which we formed about 25 years ago. That company, they continued to be a partnership. That company became defunct. So we got that company, defunct company, stuck off. And with the end of it. Now, recently, that name they have taken up and they are using it again. They themselves are using it. When they applied for it, they got it. Why not? Okay. But first you have to strike off the name of that other company. Once the name is removed, it is available again. You can use it. Why not? Enjoy. It is not notional income. Yeah, something like that. It's a perquisite, notional, deemed income. Yeah, yes, exactly. They don't have to be paid tax on that. Anyway. So, yeah, it is a kind of notional income because, see, the income has not yet accrued. When it will accrue? Only when the share is actually sold. But the law is creating a legal fiction and saying, hey, on the day you are getting it, you have to pay on the difference. Take it. And that's why they are not bringing it as capital gain. They are bringing it as perquisites. They are linking it with employee compensation. So the company will book it as employee compensation. Anyway, fantastic. Moving on to preference shares. We already know that preference shares are those shares which carry a preferential right as to dividend. A preferential right as to dividend and preferential right to receive repayment of capital. Now, Ms. Tunishka, now I'm going to take up the question that you told. What you should remember is, as per the section, definition of preference shares have a preferential right to receive dividend and they will be paid dividend at a fixed rate. Also, they will be eligible for preferential right to receive capital. Without, that is notwithstanding anything contained in this act. Now you remember? So this act says, normally, preference shares should be given preference, fixed rate. Now, notwithstanding what is said, in addition to that, the preference shareholders can also have right to participate in profit. So that notwithstanding point, it is meant for providing for participatory preference shares. We'll explain to you what that is in a very short while. Before that, we will see classification of preference shares based on various criteria. First criteria is dividend payout. Based on dividend, we can have cumulative preference shares or non-cumulative preference shares. Cumulative preference shares means, see, I have to pay dividend to preference shareholders only if I have profit. Where there is no profit, how I can pay dividend? So, in an year of loss, preference shareholder will not get anything. They will get only 3 vertical lines on the forehead. That is non-cumulative. That means what? This year, no profit, no dividend, go. Next year, no profit, no dividend, go. Third year profit, that year I'll pay you dividend. That is called non-cumulative. I will pay dividend only if I have profit. Whereas cumulative, what happens? Even if there is no profit, I will make a provision for the dividend. I will keep it as a liability. And whenever I make money, whenever I have sufficient profits, I will pay the dividend. So cumulative preference shareholders, the dividend will be calculated and accumulated. That's why it's called cumulative. It is accumulated. In a year of loss also, they will be eligible for dividend, but I can't pay. Later, when I make money, at that time or at the time of winding up, they are entitled to receive that accumulated dividend. That's why it's called cumulative preference share. Non-cumulative means no such eligibility. Year of profit you take, year of loss, sorry, bye, that's all. Okay, that is what it means. So, if you see your 4.7 page, preference shares are always presumed to be cumulative and the accumulation of dividend can be excluded only by a clear provision in the articles. So, unless otherwise stated, all preference shares are cumulative. But if the articles very clearly say preference shares shall not be entitled to dividend in a year of loss, then they are non-cumulative. Okay, sir? Clear. Now, next to participatory preference share. Here, participation not in the management of the company, but in the profits of the company. Profits of the company which can be shared by the preference shareholders. Let us go through this. In a year, there is a profit. I have paid everything, provided for tax, backs, everything left. Accumulate. I have current year ka profit hai. It is enough to pay my plus some accumulated profit, whatever. This year, I can pay preference dividend 10% paid. 10% is calculated on the nominal value of the preference share. Dividend is calculated on the nominal value of the share. Face value of the share. So when they say 20% dividend, if the face value is 10 rupees, per share 2 rupees, 20%. On the nominal value, the share may be quoted in the market at 500 rupees. That is not the point. 10 rupees means 20, 1 rupee means 1 rupee. So 20 paisa only is the dividend per share. This is generally. So we have paid it. Now equity shareholders are there now. They are also getting. Beautiful. So they are getting 30% dividend. Enjoy. Now some more profit is there. Can the preference shareholders take participation in that profit? If the terms of issue say that they are entitled, then they can get some additional dividend out of the profits remaining after the equity shareholders have been paid a dividend. If there is any profit remaining, okay, baki hai, then out of that remaining, the preference shareholders can again get some dividend. At the time of issue itself, we will say, in case the equity shares dividend is paid and some profit is left over, you will get another 2% or you will get another 5% like that. Such shares are called participatory preference shares. If it is not there, then it is not non-participatory. The terms of issue should be very clearly mentioning. Okay, the right to participation should be specified in the terms of issue. If the right to participate is not mentioned, I'm reading 4.7 only. I'm only reading it. Nothing. You can read it on your own. So if the right to participate is not specified in the terms of issue, the preference shares are presumed to be non-participatory. So if the terms of issue are silent, non-participatory. If the articles are silent, cumulative. Okay. Now, somebody was asking me whether debentures are cumulative, can be cumulative. Sir, debenture, whether you have profit or not, you have to pay interest, sir. Interest is a charge on profit. Dividend is a apportionment of profit. So dividend can be paid only if I have profit. Whereas interest, debenture ka interest hai na, that should be paid even if in a year of loss you have to pay. You have to borrow money and pay the interest. You cannot say, no profit, no interest. No. Interest is a charge on profit. You understand? After paying the interest, it can become negative. I have to pay it. I have to borrow to pay interest. What to do? Okay. So the question of debenture becoming cumulative may not arise. Or it is cumulative only. By definition, debentures, I would prefer not to use the word cumulative, Mr. Srinivasan. The word cumulative is not applicable here because preference shareholders are not entitled to profits at a dividend in a year when there is no profit. But the law says you are entitled. That is cumulative. But debentures are entitled to dividend, even year of loss. Got it? You have to pay. See, that loss will be more to the extent of debenture interest provision also, it will be there. And if you don't pay it on the due date, fellow will go to court. So I hope you're able to distinguish between the two, sir. Debt is charge on profit. Interest on debt, charge on profit. In the P&L also, it comes above the line. It comes in the main P&L account. Whereas dividend will come in the below the line. It will come in the notes on accounts. Okay. Profit loss appropriation account, it will come. So this is something you might want to understand. How many years dividend can be accumulated? It can be accumulated indefinitely. Again, that will depend on the terms of issue also. But indefinitely you can accumulate. But for 2 years, if you are accumulating it, beyond that, they will get the right to vote. If for 2 years you have put 3 vertical lines, 3rd year onwards, they will be eligible to vote on all matters. Can preference shares be issued on premium? Yes, definitely. Why not? Preference shares can be issued at a discount also. I know shares cannot be issued at a discount. Preference shares cannot be issued at a discount. But preference shares can be issued at a premium. Okay. Now convertible, meaning what? At the time of issue, I am issuing it as preference share. Later, 3 years or 5 years or 7 years later, I will give them an option to convert. Meaning, after 5 years, they can choose. Either they can take the money, redemption, or they can convert these preference shares into equity shares. So, if a preference share is worth 100 rupees, if a preference share, just simple example I'm giving. See, whenever I'm giving a numerical example, no, you have a paper and pen, kagas or kalam, haath mein, okay, you have it in your hand and you write down what I'm saying. Then you won't forget it. If you only listen, now you will say, please explain again. Whereas whatever I say, you write down, you yourself will be able to understand it better. So 100 preference share price is 100 rupees per share. 100 rupees per share. The market value of this company share, nominal value of the share is 10 rupees. Market value of the company share on the date of conversion, the share market price is 50 rupees per share. 50 rupees per share. So for one preference share, how many equity shares? For one preference share, how many equity share? One preference share, 100 rupees. I have to give him, if I don't give him share, I have to give him 100 rupees. Instead, I'm giving him equity share. How many equity share I have to give? 2 equity shares of 50 rupees. 2 equity shares of 50 rupees. You got it? So conversion will happen at the market price. Okay, sir, we are unlisted company. What to do? Then you have to do a fair valuation. You have to hire a registered valuer and do a fair valuation. Based on that valuation, you will convert. Whatever it may be. So preference share price divided by equity share price, you'll get number of shares. Suppose you are getting odd decimals and all, you can pay cash. And balance only you will allot it. Okay. On conversion, if you are finding you are getting some less than 1 rupee, see, up to 1 share you can allot. But if that amount of balance is, the remainder is less than 1 price of 1 share, then you can pay in cash too. Okay. 2 equity share. You got the point now. Why I am giving this example? To help you understand. Redeemable. So convertible means they have the option to convert. Non-convertible means no option to convert. There is one more thing. Convertible itself can be fully convertible or partially convertible. Means 100 rupees, we can make it fully convertible. Means 100 rupees will get 2 equity shares. Or I can say partly convertible. 50 rupees will be convertible. 50 rupees will be non-convertible. So non-convertible portion, I will redeem and pay. Convertible portion, I'll allot share. So this is convertible, non-convertible. Redeemable, irredeemable. Okay. I think many of you might find it very simple because all this you have studied before. You are aware of it. Maybe to an extent I can go a little fast. So redeemable and irredeemable. Redeemable means it will be, amount will be paid at the end of repaid at the end of a particular period. Irredeemable means the amount will never be repaid till the winding up of the company. Okay, but remember, in India, no company shall issue irredeemable preference shares. No company shall issue irredeemable preference shares. If you want to issue preference shares, they should be redeemable within a period not exceeding 20 years. Okay, so maximum 20 years. Beyond that, you cannot go. And if you want to issue redeemable preference shares, you have to have authorization in articles. Okay, means for issue of preference shares, there should be an authorization in articles. If you want to go beyond 20 years, certain companies can go. For example, companies which are having infrastructural projects which are specially specified in Schedule 6. The Companies Act has 7 schedules. Companies Act has 7 schedules. The 6th schedule will give you the details of the infrastructural projects, right? They give, you go and see Schedule 6. You don't have to remember what it is. Schedule 6 has that, like construction of roads, bridges, hydroelectric plant. These are all infrastructure. There, infrastructure means all those assets and all those facilities which we are making for improving the country. So 25 years ago, India had very few good roads. I'm not joking. Now, almost everywhere you go in India, the main highways are all, national highways are beautifully maintained. Some of the states maintain the highways well, though some states don't. Okay, most state highways. Even the corporation controlled or panchayat controlled roads are well laid. So this is all infrastructure. So this will be done by, for example, Larsen and Toubro Limited will be hired for laying 1,000 kilometers of highway, national highway. That's an infrastructural project. Or build a hydroelectric plant. Whatever. See, these are all infrastructural projects where they will give. So those projects, for these projects, the gestation period is very long. The from the commencement of the project to commissioning, it could take 7 years, 8 years. So these companies will not make profit for at least 5 years, 6 years. Only loss will be going on. Because they will be investing money to construct and run. Only when the commissioning happens, little bit, it will turn around. Another 2 years will take. Then 7th, 8th year, when first I have to build that road, then commission it, get it certified by the NHAI. Then I have to put a toll booth, start collecting toll. Only when I finish my collection of toll, my profit will come. So it may take me 7 years, 8 years. So if I have to raise funds for that, I need money for long term. So such infrastructural projects can go for preference shares exceeding 20 years, but not exceeding 30 years. And even in those cases, once 20 years is over, 10% of such preference shares are to be redeemed annually on proportional basis. See, after 20 years, what will happen? I have another 10 years. So every year I have to repay 10%. So that by the end of the last year, almost everything will be over. So I say, and that is correct. So because I will start making good money after 15 years. So if I start repayment 10 years, I can easily repay it out of my profits. In the meantime, I should ensure that I pay interest. So please note, even if that company is making loss, it still has to service the interest. So interest will be part of the project cost. It has to be paid. Okay. See, mandatory optional, conversion may be mandatory, compulsorily convertible. That means what? At the time of issue, if I issue compulsorily convertible, the preference shareholder has no option, only conversion. But you have optionally convertible. That means he will get a choice. He can either convert or he can take money. Normally, if nothing is mentioned, it is optionally convertible. If nothing is mentioned, it will be optionally convertible. Okay. Rahul Sharma is asking if preference shares are unsecured. Sharma ji, preference shares are part of equity. Equity means share capital. Preference shares belong to preference shareholders are also owners. So it is part of the owner's capital. If you see the balance sheet, preference share capital will be coming under share capital, not under debt or non-current liabilities. You understand? Okay. So which means, how can I use the word secured, unsecured? I am the owner, yeah. Is my amount secured or unsecured? For a lender, I can say, if he is having any asset as a security, he will be secured. If he is not having any security, he is unsecured. For a owner, how I can say secured, unsecured? Please understand, the principles have to be understood very well. And these principles should have been learned in college or CPT. The nature of preference share. Share means it is owner. How can the owner, see, proprietor of a business, is he secured or unsecured? Everything is gone. What is left is his. So you should not, tell like that. Okay. What happens is preference share is redeemed 10% per year. Then interest calculate on face value or actual value. Ramja, I'm answering your question, but your question is so silly. See, boss, the interest will always be calculated on face value. What do you mean by actual value? I don't know. Baba, it is like this. If 1 lakh debentures are issued, listen to me, Ja, then you will understand it better. Listen to me first. 1 lakh debentures are issued. Now, first 10 years, I redeem 10%. First year, I will redeem 10,000 debentures fully. There will be no actual value for them. Everything will be redeemed. 10,000 debentures, I will call the buggers and pay the full amount. Now, remaining how much? 90,000 debentures are there. On that, I will pay interest. Like that. Are you able to understand? I have answered your query, sir. Huh? You are telling me, answer my query. I have answered your query. Okay. Don't worry. See, don't put a comment like that, friends. Answer my query and all. Because I'm conducting the class. No. When will I answer? Only when I get the time, I will answer. Now. So till then, you can say answer my query and all. Please, Mr. Ja, don't do that again. Okay. You raise a query and leave it. Definitely, I will answer it. Without answering, how I will go. I'm here to answer your questions. Are you able to understand, Ja? In the 7th chapter of the Bhagavad Gita, Bhagavan says to Arjuna, Idam Vakshyami Aseshatah. I will tell you everything without any sesham, without any balance, I will tell you. So don't worry. Idam vakshyami aseshaka. But don't put comment like, answer my query, like that. I mean, I know the tone is not like that, but see, when you're speaking, no, there can be tonal variety. When I'm speaking to Mr. Ramja, I can say, Mr. Ramja, please don't do like that. But if I put a comment, Mr. Ja, don't talk in the middle of the class, it may sound like a rude also. Nah? But when I'm telling you, I can tell, Mr. Ja, please don't interrupt me in the class. See, the tonal variety is there while speaking. But in the written communication, like query pad and all, no, you have to make it a little polite. How to do it is your choice. That is why language is there. So you have to learn how to use. In email, in WhatsApp, when you're talking to seniors, when you're talking to people who are above you in the hierarchy, you have to use a certain language. If you use it, it will be good. If you don't use it, what to do? Don't. That's all. It's up to you. Chalo. Now, so this is for that. Gone. Now, very, very important. Please remember this. Preference shares are to be redeemed out of the profits of the company, which would otherwise be available for dividend. So, only if that profit is available for dividend, you can redeem preference shares. Okay. There are many cases where certain amounts are not available for dividend. Example, securities premium account, not available for dividend. That great capital redemption reserve, CRR, not available for dividend. Okay. Revaluation reserve, not available for dividend. Okay. Any specific reserve earmarked, for example, statutory reserve, not available for dividend. So those items cannot be considered. Only those, so which leaves us with what? General reserve, profit and loss account, dividend equalization reserve. Basically, that reserve is meant for declaring dividend only. So such reserves only can be used. Okay. Now, so preference shares are to be redeemed out of profits of the company. The proceeds of a fresh issue of shares made for the purposes of such redemption. So simple, sir. You want to redeem 4 crore worth of nominal value of the share is 4 crore. Nominal value of the preference share is 4 crore. What you should do? You should first see your balance sheet, liability side, reserves and surplus. Look at everything. Security, general reserve, 1 crore. P&L account, 50 lakhs. That's all. So, redemption can be for how much? Maximum 1.5 crores out of profits. Out of 4 crores, 1 crore general reserve, 50 lakhs P&L account, 1.5 crores possible. Remaining 2.5, where will I get it from? It's not there. Then I cannot redeem. Or what I should do? I should issue fresh shares, maybe equity shares. Nominal value should be 2.5 crores. I may issue at a premium, but the premium cannot be used for redeeming preference shares. Premium on shares, securities premium cannot be used for redeeming preference shares. So the nominal value should be 2.5 crores. So I can make a fresh issue of shares for 2.5 crores. So maybe 10 rupees share, I might issue at 20 rupees. So 2.5 plus 2.5, 5 crore I will get. Am I correct? Out of that 2.5 crore, nominal value of the share can be used for redeeming the preference shares. So preference shares can be redeemed out of profits, which would otherwise be available for dividend. Otherwise be available means, I know you may not be understand that English, I'll explain. Otherwise be available means they will be used for paying dividend, but if I am not using it for dividend, I will use it for this. So if I am not using it for redeeming preference shares, otherwise I will be using it for payment of dividend. Only those profits which can be used for paying dividend can be used. So in case that is not sufficient, balance you have to issue fresh shares. The nominal value of the share can be considered. Okay. Now, when the preference shares are redeemed, there will be a diminution. Diminution means reduction. It will come down. The permanent capital of the company will come down. The law requires that this should be replaced. See, this is the logic of this rule. If you really apply your mind, now you will understand how beautiful it is. See, in the balance sheet, when I redeem preference shares, what will happen? I will debit preference shares, credit bank. Am I correct? Money will go out. and preference shares will go out. So on the liability side, from the permanent capital, share capital part, 5 crore will go, 4 crore will go. Now the law says, hey, if you are going to give out your permanent capital, that should be replaced. This is to protect the creditors. This is to protect the creditors. Because the creditors are looking to that amount now. So that is going now. So they are saying, look here, you want to pay the preference share? Then you do it only out of profits. In case you are not making out of profits, then bring some more money into the business, yeah? Replace that permanent capital. So that is why they are saying, either make it out of your earned money, do whatever you want with it, pay him off, or if sufficient profits are not there, bring new money, the proceeds of a fresh issue, so that the permanent capital should not be depleted. Now, when you are redeeming out of the profits, to that extent, it has to be locked now. To that extent, it has to go to the permanent capital now. Because if it is remaining in general reserve or in P&L, it can be used for paying dividend. They are saying, no, we want it to be locked. So they are saying, if you to convert free reserves, that is reserves made out of profits that are available for dividend into permanent capital. So once you are using profits for redeeming preference shares, to the extent of the nominal value of the shares, you have to transfer it to a special account called Capital Redemption Reserve Account. So the nominal value of the preference shares redeemed will have to go to the Capital Redemption Reserve. So the entry you will pass is General Reserve Account debtor. Am I correct? P&L account debtor. 2. CRR. CRR is Capital Redemption Reserve Account. Now, somebody was... so retained earnings is a word to describe reserves which are available for declaring dividends. So don't use retained earnings. See, retained earnings could also be other. For example, the Capital Redemption Reserve is also retained earnings. Securities premium account is also retained earnings. So kindly do not use the word retained earnings. Instead, for company law purpose, use the word free reserves. So preference shares can be only out of free reserves, means reserves available, profits available for dividend. If you see the definition of free reserve, it will say free reserve means any reserve which is available for the purpose of declaring dividend. But once the free reserves are transferred to CRR, they are not available for declaration of dividend. I heard earlier somebody was saying they are available for declaration of dividend or something like that. That's why I said I will not cover it now. When I come to the topic, I will cover it like that. So let me see. I think somebody was saying, no, who was that? I think it's Prajaktava. Somebody was saying. One second, I will just see it and I will. According to me, CRR is used first for redemption and preliminary expenses. No, madam. CRR cannot be used for any purpose. The only thing we can do with CRR is to issue fully paid up bonus shares. Have you got it, Ms. Prajakta Jivatkar? I am not trying to contradict you or say that you are wrong. Because unfortunately, I am the teacher here. So I am telling you, okay, section 55. The only thing we can do with CRR is issue fully paid up bonus shares. CRR is not available for declaring dividend. CRR cannot be used for redemption, writing off of preliminary expenses. No. Okay. Are you clear, madam? I hope I am clear. So that in case you are still listening to the lecture, kindly confirm that you have understood. So your statement that you made, I would not want to contradict at that time. I just wanted you to come to the current relevant topic and then tell you CRR cannot be used for issue of for any purpose other than issue of fully paid. But CRR can be used for issuing bonus shares. See, the idea is simple, ma. Fixed capital. So it doesn't matter whether I keep it in current capital redemption reserve or in, paid up capital. How does it matter? So you can as well transfer it. So CRR can be used only for issuing fully paid up bonus shares. Okay, all of you, please note it. See, these are all small stuff where they may try to where they may try to catch you out in MCQ. So they will say capital redemption reserve cannot be used for or can be used for. They might give 3 or 4 options. Issue of fully paid up bonus shares. That is the correct answer. Everything else is wrong. Okay. Okay. Now, so now again, one more thing is when you make a fresh issue of shares, then the face value of the preference shares redeemed will be replaced with the face value of the fresh issue. Suppose the fresh issue is made at a premium. Remember, the premium will go to securities premium account. Once it goes to securities premium account, remember, it can be used only for 3, not even 5, 3. Am I correct? It can be used only for 3. Issue expenses, bonus shares, buyback. That's all. You cannot use it for redeeming preference shares. So, securities premium cannot be used for redeeming preference shares. Are you able to understand? Now, you can use anyone, partly out of profits, partly out of fresh issue. But at the end of the day, preference shares will go out, profit will go to CRR to the extent of nominal value, fresh issue ka nominal value will replace the balance. Permanent capital is still intact. This is the purpose behind the rule. Okay, is the point. So, preference shares should be fully paid up. There should be authorization by special resolution for redemption. Nominal value of preference shares redeemed out of profits should be transferred to CRR, Capital Redemption Reserve Account. Mr. Ramja was talking about cash reserve ratio. There has nothing to do with this CRR, is not that CRR, sir. That CRR is a totally different thing. CRR means cash reserve ratio. Company maintains some money in reserve for, you are giving your own views, Mr. Javich. Definitely, a company should maintain some money in reserve for future unknown loss, but that is not CRR. See, the cash reserve ratio is a totally different technical point in, banking. See, the Reserve Bank of India will prescribe CRR for all the banks. All the banks have to maintain a liquid reserve. That is called CRR, cash reserve. So that in case the depositors come and ask money, they should give 15% or so they have to maintain. That is called CRR. But that is not here. That is in banking and finance, not in this topic. Okay. That CRR is different. This CRR is capital redemption reserve. Okay. Thank you, Mr. Almas, Ms. Almas Sheikh, for telling very well explained. Okay. Thank you. But any credit, if anybody is giving me, remember, it goes to my guru. All the credit you are giving me ultimately goes to my guru, Professor K. Sanantharaman. Whenever I tell his name, little bit I'll feel like crying also, because he's no longer there. Whenever I mention his name, I think that he's looking at me now from wherever he is. So, sorry, don't mistake me. Once you have a guru like him and he is not there anymore, it's a greatest loss. It cannot be explained to you. Okay? You will understand it only if you have such a good guru, not me. No, this idiot can never qualify. There must be some other better person than me who will be so good to you. They will take you under their care. They will guide you. They will make you so better than what you are. Such a person, once you have that association, that guru will, it's a different thing. I can't explain to you the joy of, being with such a guru and traveling with him for teaching. We used to go together for teaching. While I was teaching, he taught me how to teach. I used to go with him. I will sit and observe him. I will take continuous notes, how he stood, how he turned, how he smiled. Everything I will note it down. And then when I am given a chance, I will try to do. Like that, I learned from my guru, not the subject. I learned how to teach from him. So any credit, if you think this idiot at all is doing any good job here, every credit goes to my guru only, nobody else. My guru, Professor K. Santharaman. At a later stage, maybe I will show you a photograph of him, but not today. Another day, I will show you a photograph of my guru. Great person, I can tell you one thing. In fact, in my office, when he was alive, I used to tell my office people, if at all Professor Anantharaman calls you, some of you, one of you, and he says, bring me Srikant's head on a plate. Just come cut my head, take it to him. Because if my guru wanted my head, that is the correct time for me to die. Okay, this may sound very silly and may sound very old-fashioned, but this is the level at which, I have been influenced by, because see, K.S. Antraman knows when Srikant should die. If he has decided that today Srikant should die, he will tell, cut his head and bring it, that's it, kill me and go. My life would have been well left. Nothing wrong in that. Okay, so thank you for listening to this about my guru, because when I saw that Alma Sheikh's thing, immediately my mind went to my guru and I could not help but say this. Yeah. So, in fact, guru appears is correct. I may write something about how I met KSA, how I moved with him, because we used to call him KSA, not Professor K.S. Anantraman. We used to call him short form KSA. Okay. So maybe some other occasion, God will help me to write those experiences and publish it. Okay, CRR not to be used for payment of dividend, but may be utilized for issue of bonus shares. We already saw this. Now, okay, coming out of that emotional thing, let's get into a problem. Please give me the answer. Thank you, Neha Harge, for your kind words and agreeing that you know the pain. Now the answer for this. I'm waiting for your answers. Multiple choice answer. See, many of you have written correctly. A is the correct answer, but some of you are saying C. Possibly you are confusing with the amount of money needed for redemption. See, now those of you who wrote C, A is the correct answer. But C, those of you who wrote C, what you have done, see how much money you need to redeem the preference shares, 2,000 into 100, 2 lakhs. So that is the total amount needed. Out of that, what will be transferred to the CRR? Only the amount which is utilized out of profits. So here what they are doing, they are issuing 1,500 equity shares of 100 each. So that is 1,50,000, right? 1,50,000. So to the extent of 1,50,000 is coming out of issue of shares, nominal value of the equity shares. So 2 lakh minus 1,50,000, only the balance 50,000 will be out of profits. Please note, nominal value of preference shares redeemed out of profits to be transferred, not the entire preference shares redeemed. That is why this question is given with 2 lakhs. The entire preference shares need not be taken. Only the amount redeemed out, again and again you read this, nominal value of preference shares redeemed out of profits to be transferred to CRR. Got it? Now, so this is 50,000 A is the correct answer. Now, so I have given you the solution. Now, here's one more problem. Good. Ankur Patel put and submit, I think. No problem. A is the correct answer. So, see these two computational MCQs are given to help you to understand the principle involved. That's all. Ramja, I'll answer your question. You finish this and then I'll go back. See, here it's the reverse now. Here, there is some money in the P&L account and securities premium account. There is some money in the P&L account and so how much is to be taken out of by issuing? So how many shares are to be issued? That is the question. Okay. Number of, you are going to calculate minimum number of equity shares. Okay. In all cases, ignore the premium. Here also ignore the premium. See, you are going to redeem it at the premium of 10%. Right? You are issuing the equity shares at premium of 20%. It doesn't matter. The premium on redemption is a cost. The premium that you're collecting is a securities premium account. Now, somebody was rightly pointing out, I'll see. Now, Ramja only, I think. That is, see, this premium, somebody was asking, premium can be used to redeem the security premium used for redeem the security premium. Correct. Who said it? Harsh Chandra is saying the security premium collected now from this equity shares of 100 each. You are collecting 20% now per share. That is 20 rupees now. That 20 into 1500, 30,000 can be used for writing off the redemption premium of 10%. That is 10 into 10% of 2 lakhs, 20,000. So this 30,000 that you are collecting from the new equity shareholders, now security premium, that can be used to write off the premium that you are paying on redemption. Yes, that is allowed. As per section 815, it is allowed. Got it? It can be used. Same way here also. So, but ignore the premium. Here, how many shares you have to issue? Only the nominal value. And the face value of the share is 10 rupees. That is also given. So, how many shares are to be issued is the question. So, already you are using from profit now. So, how much you need? 10,000 of rupees 10 each. Ignore the premium. 10,000 into 10, 1 lakh. I need 1 lakh. How much is there in P&L account? 60,000. Securities premium account cannot be used for redeeming preference shares. Don't touch it. Which means only 60,000 can be taken. So 1 lakh minus 60,000, I have 40,000. So 40,000 I need. How many shares of 10 rupees each? 4,000. That is the correct answer. Got it? 4,000 is the correct answer. Right? Now, when I'm issuing these 4,000 shares now, 10 rupees plus 20%, 2 rupees. I will issue it at 12 rupees. 4,000 into 12. Got it? It will be 48,000. That 8,000 premium, along with this already 10,000 premium, that you can use it for writing off the premium on redemption of preferences. Got it? 10,000 you will be having premium on redemption of preferences. That 10,000 you can write it off like that. Okay? So securities premium can be used for writing off the premium on redemption. Right? So A is the correct answer. 4,000 is the correct answer. Okay? D is also not correct. B is not correct. C is also not correct. Okay? A is the correct answer. See, this MCQ is very, very dangerous. If in a written answer, suppose you write the law correctly, but your conclusion is wrong, you will still get 40 to 45%, 50% of the marks you will get. But if MCQ, you make the wrong conclusion, gone. That is why those students like MCQ, they don't realize that it is very dangerous and very, very different. And as somebody was asking, if negative marking is also there, it becomes even more boring. Descriptive is better, yeah. See, this Company Secretary Institute, they went for a disastrous experiment and they went into MCQ for accounting and costing and all. Then now they have gone back to descriptive. Because, see, there are only so many multiple choice questions you can ask, After 5th session, 6th session, repeats will start happening. Students will start double guessing, mug up the answers and come. Without even understanding the subject, they'll mug up the answers and like that. Like it will become like IAS exam. Capital of Bihar is Jamshedpur, Rourkela, Patna, Chennai. And you have to choose one. So, for IAS exam, yes. But for professional exams, it becomes... So, they realized. and they have now changed it back to descriptive. Okay. Anyway, see here. Boss, prefer MCQ, you like it, you enjoy it. I have no problem. You enjoy MCQ, do it. But very dangerous. See, it's not as if I have not done MCQ question answers. I have cleared my CISA examination, Certified Information Systems Auditor. There it is practical questions. And they'll give you 4 options. Unless you have practical knowledge in information systems audit, you cannot answer that. You should have real depth knowledge. Otherwise, you cannot answer that. 4 options will look similar. Only man who knows the reality can answer the right one. So there you have 200 questions. You have to answer it in 4 hours. Okay, $200 for 400. $200 for 400 questions. $200 for 200 questions. You have to answer in 4 hours, and like that. So $200 for 200 questions. So we used to say $1 per question. So if you answer a question wrong, $1 out. So and there the evaluation is not passed. It is like they will count the marks across the world and then calculate the percentiles, and then they'll see which mark is above the 79th percentile. They will see 75th percentile. They will see 75th percentile ka mark is the pass mark. So out of 200, if 175 is the 75th percentile, then anybody who got 175 and more right only will pass. 174 is fail. Like that. It is not 40%, 50% and all. Like that. Very confusing. I was in the 79th percentile. My mark was in the 79th percentile. I cleared. Okay. So why I'm giving all this unnecessary stuff to you? It's not that MCQ is. I'm not afraid of MCQ, but MCQ needs a totally different approach. No. I call myself idiot. I have the right to call myself an idiot because the minute I think I'm intelligent, no, I'll become a fool. The minute I think I'm a fool, no, I will learn more and I will become intelligent. That is why I call myself as fool, idiot and all. Nothing wrong. Nothing wrong. Okay. This is also a tradition taught by our great gurus to not to consider yourself to be intelligent, but always to think of yourself as a less than intelligent. Then only you will learn. The minute you think I know, then ego will come. Then very difficult. Anyway, what I'm going to do, this slide I will teach and stop today. Preference shares, in case the redemption is there, you have to redeem. But at the time of redemption, the company does not have money to pay. Failure in payment. So the company is unable to redeem preference shares or pay dividend on the preference shares. Then it has to go to 3/4 in value of the preference shareholders have to agree. 3/4 in value. The same way now where there we saw holders of 3/4 of the issued capital. Like that, here holders of 3/4 in value of the preference shareholder. Means, for example, in this example, 10,000 preference shares of rupees 10 each. So 1 lakh. So minimum 75,000 ka holders should agree. Preference shareholders holding 75,000 minimum should agree. Okay. They should get the consent of these holders. Then they should go to the tribunal and say, we are unable to pay. Please help us. I've got the consent of 3/4. Meeting over. Then tribunal will hear the matter, satisfy that everything is in order. Then they will direct the company to issue further redeemable preference shares. Meaning, I issued redeemable preference shares for 10 years. Now, 10th year, I'm saying, please. So they'll say, another 5 years you take. You further redeemable preference shares. Okay. In case, as usual, there are any dissenting fellows. See, 75 have agreed, but the remaining 25% or maybe 80% would have agreed. Remaining 20% have not agreed. Those dissenting shareholders are to be paid forthwith. Forthwith is different from immediately. Immediately means next minute. Forthwith means ASAP, as soon as possible. As soon as possible, you have to pay. Okay. For the dissenting shareholders. Dissenting means those guys who do not agree, who do not give their consent. Now, the unredeemed preference shares shall be deemed to have been redeemed. Okay. So this is the procedure for a case where company is unable to make the redemption. How about the preference shareholders who are not consented? Tribunal shall, while giving approval, order the redemption forthwith of preference shares held by them. This is what we saw here. Forthwith, they have to be redeemed. Fantastic. Today, I was thinking I could get into transfer and transmission. Today, I was honestly thinking I could get into that. But tomorrow we'll take it up. Tomorrow also we have a class. I have one question. Why we are not solve premium side? Hey, I'm not able to understand your question, Mansi. What to do? You want me to work out a problem on premium? Nothing. There's nothing great about premium now. Anyway, if you have a doubt, you can ask me. Thank you. So nice of you, Ms. Pooja Gupta. Then how will I? Thank you. Great. So let's call it a great evening, and we'll go on like. Why but security premium, why are not used? Because see, security premium account can be used only for 3 matters now. If you are following the accounting standards, only 3 matters. What are they? Issue of bonus shares, redemption of, writing off of premium on redemption. Got it? And buyback. So, which means what? Listen to me, Mansiji. Security premium cannot be used for redeeming preference shares because it can be used only for 3 things. So, other than that, it cannot be used now. That is the logic. Hope you got it. Wonderful, wonderful. Great. Have a great evening ahead and great day tomorrow. Inshallah, we'll meet tomorrow evening, 6 p.m. Bye.